So, hi everyone. This is Finance Meets Real Estate. We do weekly webinars every Tuesday. As you guys know, today we have an amazing guest, Spencer Hilligoss. He's joining us out from the Bay Area, and he's the co-founder of Madison Investing. He's going to talk about how he chooses their investing strategy, and also how to choose between active and passive investing. So prior to his real estate investing career, which spans multifamily self-storage and other niche asset classes, Spencer has been in the technology industry, so including positions at Intuit and Gusto, and a 13-year track record of building high-performing teams across 5 companies. So he has a great background. I'm really interested to hear what he has to say here today. He's also active on LinkedIn, other platforms. I've been following his content, and he's a great guy. So it's a pleasure to have him on. So we're doing an open format Q&A. So if you guys have any questions, feel free to speak up. And the recording of this is going to be on YouTube as well. So with that, I'm going to pass it on to Spencer. And yeah, so if you have any questions, please speak or put them on the chat. Thank you.
Cool. Well, thanks so much for that really generous and thoughtful intro, Stefan. I really appreciate that. And thank you all for logging in to hear me ramble. Yeah, so for just some quick background on me, and sorry, I just realized, sorry for the floating head. When I wear a black shirt, it looks like I'm part of this couch. So this is kind of how it goes. But I think I'm based in the Bay Area, as Stefan mentioned, was in fintech companies largely for 13 years. Prior to that, actually, I grew up in a real estate household. My dad was a residential real estate broker for 30 years, and he had me working in his company at a young age. And so I don't know if it counts for anything, but I did technically start in real estate at the age of 6, but I don't think that counts for much in those early years. I got scared out of real estate because I didn't want to tell my friends the uncool stuff I was working on. When you work in the Bay Area, people like to talk about tech. People like to work on the newest, most cutting edge thing. A lot of friends would be like, "Oh, you're working for your dad again?" And yeah, I mean, I'm making light of this and just cracking a joke, because we're all at the end of our days right now. But I would just say that there was something there, So I ran into 13 years in tech companies and stumbled my way into what has now become my full-time passion. And now we are, when I say we, it's Jennifer Morimoto is the co-founder and COO of our company, Madison Investing. Really just an investing group, and we are limited partners on many deals ourselves. We invest in these deals ourselves. We also now, I'm active as well. And so I've been in 31 deals, including multifamily and self-storage facilities actively, between single asset funds, like value add strategies across Sunbelt markets, and a little bit more Western in the past 24 months in particular, between like Arizona, Idaho, Colorado, markets more like on our neck of the woods nationally. But all that said, I'm a very transparent guy. I strive to be an open book however I can. I think that when I got the invite to come speak today, I was excited because it just basically gets to talk about what I consider to be personally like the most underserved, underdiscussed topic, not without being dramatic. I know it sounds like hyperbole, but like many of you have probably heard, great podcasts, in addition to this one, and read books and articles and blogs out there, maybe hit up their bigger pockets, all of that is critical sources of information. But I personally always felt like it was really hard to find great content and even just like sounding boards with other folks who are at least a equatable like-kind stage of professional or personal life, where it was like, how do I know which strategy to pick? And every piece of content that I found out there tended to go straight to the asset type, straight to go do single family, go do self-storage, go do senior living, go do industrial, what have you. But there's this layer of like really confusing and disorienting, hard decision-making and deep work that has to go into like, how do I pick what I'm going to go do and why. Why am I going to do these things? How do I measure if I've gotten there? What are my check-ins? And so all those things kind of came to mind when we were talking about how to put together the stuff for today. And I don't have visual aid. You're stuck with just me, but I'm very much happy to go into any level of depth or just answer questions or whatever could be helpful. But let me know, and I can kind of jump into stuff that is more kind of just me methodically walking through how I think about how we did it, at least.
Right. And so Spencer, so just if I may interject, like just as background, because you mentioned like 31 deals. So let's say how many of them are as LP and how many of them as GP as a high level picture?
Yeah, those ones are just the active ones. On a good,
wow.
Yeah, I know a good chunk of those are LP. I can't remember top of mind, sorry. But yeah, there's quite a few on the LP side.
Got it. But then you also helped in some capital raise for those, or was it, or they were like purely like your own investments in that case?
Yeah, so our business structure is very deliberate. We started off on the journey being just pure LP investors, and I was working full time up until the end of 2019. And 5 months before COVID, I put in my notice. I was leading teams of folks, and I was actually at the time the biggest bridge lender in the country for fix and flips for single family homes. It was at Lending Home, one of the many lending something name companies. And I was building their origination groups, and then eventually led their professional development training team. While I was there, I was doing all the building and all the LP stuff, vetting, making our own vetting criteria, and then eventually realizing, yeah, we could probably build a business around this. And so that was a labor of love. That was the nights and weekends. I'm more of a morning guy, so that was probably 4 to 6 a.m. for a period of 2.5 to 3 years of focused work in the mornings before I'd go in and have to lead and motivate people and also support them and do a bunch of really hard work. So that was kind of the story leading up to 2019, and then 5 months before COVID, I quit, and that was a heck of a timing. Apparently, that was like before the Great Resignation happened, or got branded with that really cool looking term that's easy to say now. But yeah, that was kind of the journey.
Mm-hmm. Great. So how did you, like, if you want to kind of guide us through, like, how you decided, I guess, to go full time in real estate investing? Because I mean, presumably, because you're saying you started with LP, so that's kind of a little bit. It can be like quality investments where you, let's say, seek alpha, so to say, right? But it's not necessarily an income source, right? Because it's not necessarily something where you generate, be it acquisition fees or agent fees or et cetera, et cetera. So what was your like reasoning at the time? Like what kind of motivated your, like business decision and transition and that?
Yeah. So I think stepping back before I kind of go into the split between how we looked and set goals around active versus passive and like what's a monthly cash flow income number that we want to have between both sources. I will just say that there was a killer and critically important exercise that Jennifer and I, who's my wife and co-founder, she and I took 2 whole weekends and we completed this exercise that was not some perfectly mapped thing. I don't claim that it was like a perfectly constructed corporate exercise, but it worked for us. And we went down to a very simple number. And this is the first thing I wanted to make sure that I conveyed to folks tonight, because at least it was helpful for us. Some of you might think, wow, that's really simple. So simple. I don't even know if that is a good idea. And I'm like, well, I like simple. I think simple plans, it's harder to make a simple, effective plan than it is to make an overly convoluted one, right? And I think oftentimes, whether it's our 401k custodians or it's a financial advisor or someone out there giving me advice, I've always felt like the notion of portfolio planning as being overly complex depending on what you're trying to do. We picked a number. We just said, what is the number of cash income on a monthly basis that our household needs for us to, in phases, start to replace my income? Because both Jennifer, she had her own career. She was a marketing and e-commerce leader at her company. She worked for a CPG company called Torani for a long time. And then I was doing operations, sales, all this other leadership stuff in my other career. So 2 incomes, like how do we go and figure out how to start replacing that income for both of us over time Eventually, I'd be able to quit and go focus full time on our business. Eventually, she'd be able to quit and also join me in serving our business and helping our investors, et cetera. All of that has happened now. That's the good news. But it started off with saying, let's just set that number. Like, what is the monthly number? And that weekend, that is the part by far, I would say, Stefan, that people just want to cruise right by. Is I think most people on this call probably have some kind of partner, significant other. I'm talking personal partner. I don't mean professional partner, I mean personal partner. And each household will be different. The way you handle your finances will be different. And there is no truly right way. What worked for us was really getting down into where do we want that number to get hit? How do we want that number to get hit? And in how many years? Started off, we were like, let's go 15 years out, way too far out. Let's chop it in half. Let's go 7 years. That's what we stuck with. So we said 7 years. And then we started working toward building our plan around that. There was tears, there was reconciliation in those weekends. There was debate. There was a lot of very big soul searching stuff before we ultimately decided on locking on that number. But I just wanted to hone on that plan because it's so easy to go into the pragmatic kind of asset level stuff and active versus passive stuff first. And for us, that was a huge deal. That was the biggest deal. And had we skipped that exercise, I don't think any of this would have really happened, because you got to work through that heavy stuff first with your significant other and your partner. So that's where we started. Went to then evaluate different means of investing. We went through our phase where we bought some rentals. We bought a local rental, spent $430,000 on it in the Bay Area, California, and that got us $200 a month in cash flow. And that was before we knew how to cash flow goal set. So that wasn't a great home run. Thankfully, it's appreciated, and you can do a cash out refi on it now, which is happening right now, but it's not the same as a cash flow investment. We then went further outside of California, built a modest portfolio, but it was I got up to 5 properties, single family rentals. We bought them turnkey in the Midwest. It was in Kansas City, Missouri, and they were doing roughly $200 a month in cash flow. For $60,000 purchase price on average, and that's just confusing as hell for me here in the Bay Area. As a guy who's been looking at the price points that we see out here generally, I was like, wow, that's ridiculously low. We since have sold those. So they performed well for a while, and we sold them because ultimately it was more overhead than we wanted to deal with as people with 2 young kids of our own, very busy business. I'm not anti-rentals. I very firmly believe that no one's going to convince me that a rental is passive. Rentals are semi-passive at best. That's not a dig. That's just a reality. Unless someone considers to be, fielding property tax mail, fielding stuff from the city, even though you have a property manager and you live states away, fielding stuff from the city, complaining about a couch that's on someone's lawn that shouldn't be there. Having to deal with utilities that are, people tracking you down despite the fact you have a property manager. All these different reasons was why we kind of went through that rental phase. And I'm not anti-rental. Frankly, that's going to come back into our strategy eventually. It's just not in line right now. We can't spare the time. Those 2 phases were super important. After we had goal set, we started buying small property. Then we grew out of it because we just realized that overhead and that time commitment wasn't going to scale. And so that's where we leaned more into the LP investing. So we started doing stuff in like Huntsville, Alabama was one of the earlier ones we did for an LP multifamily investment. Have done a whole bunch in Texas, Dallas, Texas, have done stuff in North Carolina, and now just a ton of active stuff across the board. And that's where we get to the fun conversation kind of around active and passive and like, how do we think about that? Because that was probably the next big phase of business execution for us, was like looking at, okay, people want to be fully passive. That's a beautiful vision. And I think that is something that we ultimately are going to be doing too. But I don't want to sit on a beach. I know that everyone thinks that they want to go do that and like literally do nothing. I would get bored out of my mind. So I do think that most human beings, whether they know it or not, will be living to their best life and potential when they're still doing something of value in the world. And that's how I see that. Anyone else can approach it in their own way. And I say all that because I wake up every morning very fired up to be able to serve the people we work with actively in Madison Investing now, our investors and also our partners that we work with. And so that has been a wonderful experience doing that as like my full-time job, which doesn't really feel like a job. It's helping people solve a problem, which is finding great deals and investing in those deals. And that's how it starts for all of us, is we just go and find deals and people we like to invest with already. We invest with them. And then once we've done that, we then see if it's going to be a good fit for potential bigger partnership after that. And then we'll kind of find the good deals that they happen to do and share them with our group. But I just talked to you solid for 5 minutes, so I will shut up.
So Spencer, actually, that initial thought process, like where we said you guys gathered like as a family, or as a family, and kind of had a discussion as to where, what your number is going to be like, so that you can be, let's say, cover your expenses, or, live the life that you want to live in terms of lifestyle, be it financial freedom, whichever goes personally you guys had. And so from that point, just numerically, now you have to, let's say you're considering rentals, and let's say it's a $200 a month cash flow. How do you replace a technology executive income with a stream of rental properties of $200 a month, right? That's pretty hard. You need a huge number of them, so that's kind of like, so what was your thought process in that? And then on the LP side, my consideration would be, okay, while LP projects can realize a very high equity upside, let's say, they do have it's always an 8% pref, or let's say at most a 10% or 7% pref, things like that. But that's kind of your cash flow, really. So it's a pretty fixed cash flow. So how was that? I guess sufficient, or was that kind of the goal that you guys had in mind, percentage-wise, that let's say around 8% would suffice based on like job savings and all that you guys had before, or like what was your thinking as far as going after what I think is a high goal of replacing a technology company income? Because I think like for many people, it's just like that's like the challenge of becoming full-time in real estate or other industries. They have like this huge opportunity cost, and it's really not so easy as it sounds, to actually achieve it. So so
it's quite hard.
Yeah, exactly.
It's quite hard. It's not for everybody. I think more and more as we kind of keep growing our investment group at Madison, like I've really come to realize that path at the pace that we did it is not going to be for everybody, and that's absolutely fine, because I don't think that just because we did something a certain way doesn't mean that everyone else should. Examples, we have folks that since I started my career in tech companies, a lot of the folks in our network and our investor group are from the first wave of them, the first group of them, roughly half, maybe it's a swag number, came from Apple, Facebook, Google, Salesforce. Now we work with folks all over the country from an array of industries and backgrounds, but that was the background at the time, for the first groups of investors with us. And if you ask them, are you happy at your job? Frankly, most of them will say, yeah. And I'm a very pro. I know the real estate investing community at large, just generally, I don't think I'm going to offend anyone by saying this, that people kind of rip on the W-2 corporate world hard. And I don't have a bone to pick there. I thought it was really hard sometimes. And I definitely had moments where, I missed seeing my kids more than I would have liked at a couple of the companies. But all in all, I wouldn't have so many of these wonderful relationships with mentors and now investors that were former colleagues because of that. So I just wanted to mention that briefly. I think it's important. In terms of phasing, I didn't retire just purely on passive or retire. I didn't go and start doing full-time at Madison. It was because we wanted to accelerate it. So I started joining GP teams. I would strategically join on once we got to know a certain partner and really took the time, flew out, got into their GP team. At first, I was just trying to learn. And this is after I devoured 24 books in the course of a 18-month period, listened to 400 plus podcasts, subjected myself to 3 different paid coaching programs that I thought some were really helpful. Some were just okay. All this stuff, and I like nerdy depth. I like operations. I like this stuff. I'm not inherently a finance dude. I do think a lot of folks think that you have to be really interested in that stuff inherently. And I don't think finance is inherently interesting. I do think that It's important to understand it though. And it's really important to put the work in to get to the point where you can at least make smart decisions about the stuff that you get into. So all that said, yeah, we started partnering actively on deals, and we're lucky enough to partner up with some folks that ended up letting me join, and help out in ways that I could add value, because there's other ways that you can help, and anyone can. Like, I've been building teams for fintech for the past 13 years, and that means, all buzzwords aside, I've hired hundreds of people at every level. I've built these processes and email flows and like infrastructure and CRM stuff, and all that stuff is helpful when you're partnering with other folks who know how to manage an asset or acquire an asset or win a deal or convince a broker that they should be the first phone call or all those things. And so joining those kinds of teams was really helpful, because it could allow us to basically, create some kind of additional income in addition to our passive, and then just ramp it up over time. It's really all there is to it. There's no other mystery besides those components.
Yeah, that makes sense. And so as far as let's say like the GP teams that you joined and presumably helped like capital raise some of those deals. Mm-hmm. So what was your, you mentioned that initially like much of the capital raising source was from, like other technology, like kind of like technology employees, from companies like Apple, Google, etc. So how did that go? And like, how has this source been replaced later? Has it become more, I guess, technology driven in the sense of, more like be it social media or like other online funnels and lead generation and so forth, or how has it evolved for you?
Yeah, and you're asking specifically just about investors, right? Like communicating.
Yeah, investors. Yeah. Mm-hmm.
Cool. Yeah, so I think just generally you'll hear a lot of folks talk about it as your first degree connections, to use like the LinkedIn verbiage. That was the same for me, which is for folks to know me well, like you got to know that like although I have sat in seats that are like operations leadership gigs and sales leadership gigs for parts of my career, I don't wake up in the morning and want to go sell people on something. That just kind of gives me the heebie-jeebies. And I think I have to understand something well enough to get excited about it. I have to believe in something to get behind it. And I say that because all we were doing was just having conversations with my colleagues at the time, with family members, et cetera. And then once we got through that initial phase, I was just networking like a madman. I was going to local events, local meetups. I was on bigger pockets really intensely. I was doing all that stuff, as you know, and you mentioned, and I appreciate the kind words about LinkedIn. I posted myself on LinkedIn, something ridiculous. Like it was like 800 posts in the course of, what was it? 3 years. It was a labor of love, myself doing that every day. That wasn't like an outsourcer doing it for me. That was me writing them. And that was a deliberate focus on trying to get the brand awareness and also just make connections like authentically with people. I've dialed back some of the social media stuff because now our number one source of new investors is really just happy current investors. That is like literally our number one source of new membership growth is just repeat investors bringing in folks that they vouch for. And I don't think we necessarily have a very big funnel, to use the marketing terms. We haven't paid for advertising. We haven't gone out and done that. We've done some content. I've definitely written my share of Forbes articles and stuff a few years ago. We got some good press from Business Insider a few years ago. Grateful for all of that. Grateful to be here spending time with you. And I think that said, we try to stay true to what we know, and what I know is just to be as helpful as I can be, while also being authentic and direct about my feedback on things and walk the walk on how we put money to use. And then we tell people they'll never see a deal in our group unless we've already invested our own money with the sponsor. That's a fact. So it's slow and deliberate, and that is a process that I think a lot of people tend to hear, and they're like, "Oh, well, that makes a lot of sense." And I'm like, "Yeah, it's not glamorous. It's just what works." And I think that is it just takes patience and discipline to say no a lot. That's kind of the hard thing. Is basically just you will have to pass on, and I have to pass on a lot of great looking deals because sometimes they'll come across my desk and they look great, but they're with a person or a team that I just don't know. I don't know them yet. And so the answer is not no. The answer is just, hey, not yet. Let's get to know each other. And if it looks like a good fit, it'd be great to invest in your deal. And that's a really helpful way to start the conversation.
And you mentioned basically as far as picking strategies, investment strategies, rather than, let's say, just assets, right? So it's not just picking, oh, I'm going to invest in industrial, et cetera. It's more like the strategy behind it. So what are some strategies that you thought of and kind of considered, if you want to go into that, and like what mostly caught your attention and personal investment taste?
Yeah, I think that one of those debates that always, it was always educational for me. And I don't claim to be an expert on this. I'll just say that this is how I think about it. Was you'll hear what's a tactic versus what's a strategy, right? Endless loops on that topic of what qualifies as an actual strategy. For me, what I mean by strategy when it comes to picking our strategy for investing, active versus passive, and somewhere on that spectrum, is so fundamental. I mean, like based on your background, you're going to hear it, Stefan, and just be like, oh, well, that's obvious. But honestly, for a lot of people, based on my hundreds of discussions with folks, this point is not obvious, which is that when folks are trying to decide what to go do, and are they evaluating where they are at in their stage of life based on their capital readiness, like how much capital do they have to invest, how much time do they have available to invest, how much expertise do they have under their belt? And that's kind of how I look at it between these three levels, right? You basically got time, expertise, and you really have to just evaluate capital. And by capital, I don't just mean money. I actually mean health, like physical health, the energy, relationship capital, more broad definition of that. And so those three things, taking stock of it and really asking myself, like, well, you can have a capital engine, you need capital to invest, and then you got to go put that capital to use and it could feed back to itself. Those are the two component parts of that investing strategy overall. And I really think growth and cash flow, people want to overcomplicate it all the time. And I do it myself too. I get spun up on, well, let's go look at the equity multiple on this deal. Let's go look at the hold period. Let's go look at the asset type. Let's vet the sponsor. Let's go take a look. But in the end, like stopping, going all the way back to that first thing we talked about when we kicked off here today, which is, okay, what's our goal, guys? Oh, our goal is to hit this amount of income for cash flow. And that just happened to be ours at that time for that one exercise, right? It's evolved since then. But for us, that means the cash flow goal. And that cash flow, am I willing to forego growth on a certain investment? Like if I'm looking at a multifamily deal, for example, and it's got kind of those characteristics of the many multifamily deals that are out there that say something like a, 7% pref, just like you said, like 70-30 split, 50-50 hurdle after they hit the either equity multiple or the IRR hurdle. That stuff, great. But when I'm looking at those, am I really sitting there and asking myself, like, does this investment, if I were to do this, get me closer to my cash flow target that we set as that goal by how much? And then weigh it against other things in the market for opportunity costs, And again, that sounds so simple, but I really do feel like that was not simple to me when I first started investing in these types of things, because the cash flow component is very real. And until it becomes a non-issue for someone because they've kind of solved it, then I think it could be disorienting.
But and we're going to go, we have like questions from a couple of people, but they just want to make sure, because you said you're in Western markets and the Sun Belt, right? And you have Idaho, Colorado, Arizona, and southern states, right, as well. But then, and I think you mentioned Huntsville, Alabama, so maybe that qualifies a little bit more in that direction, but it's not like the typical cash flow markets. It's not the Midwest, right? So what is the reason then you didn't seek deals in the Midwest, just not, perhaps like not having like kind of the personal side that you mentioned, let's say partners investing in the other regions, I presume, since like the majority of people, they cycle invest in the Sun Belt and Western markets.
I think it just depends on, there's so many factors there that you raised. I think you kind of raised it within the question itself. I've seen great deals in Kansas City, I mean, in addition to just the one I'm using as a random example, right? For cash flow purposes. But ultimately, I only have 24 hours in a day. And so I think that's ultimately just, we have to pick deals also with teams, because, there are great sponsors I believe in personally. I back them. I vouch for them. I've never partnered with them on a deal. I've never put capital use in their deals, but I know that they've got a great reputation and a good track record, and they're based in like the Midwest, right? And so that could be a good fit for someone. Absolutely. We just happen to find, I think a lot of times I have found, and again, I'm speaking for myself, great cash flow means something very different for a person who's been through, let's just say, you can't see my gray hair very well. It is there, I promise you. But like for people who have more gray hair than me as a percentage, and that's me alluding to people who have been through more cycles around the sun and seen more of life and been through more market cycles. There's people out there, and good on them. They believe you have to be through 2 whole real estate cycles or market cycles to have any valid opinion on real estate. Do I think that's right? No. Do I think I'm right? No. I think everyone has an opinion, and they have a perspective, and they have their own investing thesis. So what does good cash flow mean? Well, it's whatever you define it as, right? For your money. So I think it gets confusing for folks when they start to define things as good, not good, in a black and white kind of draconian way.
Yeah, and there is also kind of return on effort and all those other aspects.
That's right.
If it's too much hassle, it's frequently accompanied with that and so forth. So yeah, Nelson, go ahead.
Yeah, and Stefan, thank you. And as always, you have great guests on. Spencer, quick question. Mentioned something about, this is about 40-50% of this thing has been on cash flow. As you were going through this cycle, because I think you're like a cycle kind of guy, when things cycle, as you were going through that cycle, and then you were able to hit that nut, so to speak, that number that took care of your cash flow, how and what did that change your strategy going forward? Was it like, okay, now we're just going to go for capital gains, honey? Or was it, no, we want more cash flow? Because I'm assuming that it was, you needed X amount, but in your guys' case, you probably said, let's play it safe. Let's get X plus Y, because now it's all based on us. Yeah. So let's get X plus Y. And then once we hit that, what was the fork in the road, so to speak? Was it, we're going to shoot for capital gains now and, go for home runs? Could you talk about that for a bit?
Yeah. Thank you for that thoughtful question, Nelson. I really appreciate that, man. Gosh. And I think someone's rocking some music, so I don't know whoever's rocking. I am a music guy, hence all the tattoos, by the way. So I don't know if someone could go on mute. That's some funky music playing right now too. I think in terms of
Spencer, if you can unmute, I just muted everyone just for a second. Yep.
Cool. I love when hosts use the Uber button. Yeah, the Uber mute. To your question, Nelson, there was 2 numbers that come to mind. I think this is a rough swag, so bear with me. I haven't thought about this in quite a while, but I think we realized that I was okay, pulling the ripcord or whatever you want to call it, about quitting once we had replaced at least around 70% of my income. But that wasn't your question. Your question was kind of how did it change, right? How did our goals change once we got to that point where I realized that I was at that quitting threshold, right? I think that we learned so much on that journey from getting from point A to point B. If point B were to be that quit ready, I don't know what the term would be there, but ready to move on and just full-time invest as well as just be active partner in some real estate deals as well. And I think what changed was realizing that I wanted to actually spend so much, I was already looking at each deal as an LP, as a limited partner passive investor myself. And I was like, okay, well, it makes sense. I can add more value and actually do some active stuff, whether it's, a consulting thing, whether it's trying to, if there's bringing equity capital to deals, or if it's something, because I like helping, I like solving problems. And that's kind of the way that the market works, the free market works, right? Is if at its core, at its simplest level, is if someone is doing something of value for other people, then ideally the market will reward them with financial compensation at some point, being really high level and abstract. But that was where I landed by the time I got to that point. And I wasn't expecting that. I really wasn't expecting to feel that way, where it was bottom line, wasn't necessarily gunning for as much cash flow at that point as I thought I would, you know, and I think that ultimately growth seemed very appealing too. And now that's kind of where I'm at as well, which is I love cash flow. Cash flow is great. And I've yet to really go all in on a deal that doesn't have some kind of cash flow. I personally have not invested. No. I've invested in one deal that was pure development as an LP. But other than that, every other one has been cash flow on some level.
So we're talking, and by growth, you mean all capital appreciation?
Correct. Sorry. Yeah, exactly right.
Okay. Okay. All right.
Really cool.
Yeah. Okay, thank you.
Hey, Stefan, can I ask a question?
Yeah, go ahead, Jagdish.
Okay. So, Spencer, earlier in the in your talk, you mentioned a couple of things, right? One is that most of people start saying, "Do this asset class, do that asset class," but you wanted to understand the why. And then you also mentioned soon after that about investing out of state. So how did you address the why? Was it this whole thing about listening to 400 podcasts and reading all those books? Did that give you the answer as to which direction you should go in, either strategy or asset class? And then secondly, how did you develop the comfort to actually say, I'm just going to go invest in many states away and somehow it's going to come together? Like that obviously takes a certain level of risk appetite to do that, right? So you could have stuck closer to the Bay Area for obvious reasons. I'm sure things are expensive in the Bay Area, so you went out of state. But then how did you develop that comfort? Did you just kind of fly there many times, or was it all based on the internet?
Oh, that's a fun question. Thank you, Jagdish. Am I pronouncing your name correctly?
Yeah, you're doing it fine. Great.
Okay, thank you. I have the last name Hilligoss, so I've had to get used to people editing that real time. Yeah, first kind of layer of your really good question. The comfort level. Well, let's just maybe take the easiest part first, which is the comfort level. You know, I think the comfort level. This is such a corny sounding platitude, but I really believe it, and I've seen it work for me, and I've seen it work for dozens of other people in my corporate capacity, which is you know, confidence or competence breeds confidence, right? And I truly believe in that one, at least insofar as whenever I felt uncomfortable to the degree where I couldn't take action, I was like, okay, go learn a lot more. Work really hard on learning that thing, like that one thing. Did I need to read 24 books? Hell no. Like that was above and beyond what was necessary. That was like getting into that territory that we'll have to kind of watch out for. I feel like, certainly me as well, is like, you know, analysis paralysis. And are you moving forward by devouring content after a certain point? I would argue I wasn't, probably after book 6. You know, I think on same thing for podcasts, insofar as using that as like an excuse before going and doing more. What really broke the comfort zone for me, and this is coming from a guy it sounds counterintuitive again, but like I'm an introvert. It doesn't mean I'm shy. It just means that I can't go into a conference and network for 3 days straight. I am tapped out with like 2 hours and then I need a break. So I'm going to go out and put myself in situations, though, and this is what I did, where I had to go out and talk about this stuff. I had to go and get in debates, friendly debates, right? You go to meetups, you go to conferences, you have Zoom calls with people across the world, you know, across the country and the world, and just ask them, you know, put work into questions and like really listen, you know, and that was my approach to expanding my comfort zone, because I know if I can't explain it to someone, I don't understand it, you know, and if I can't explain it simply, I really don't understand it. And so that was the first comfort zone kind of call out. On the topic overall, buying sight unseen. I think buying sight unseen, I had a couple online things that were helpful to make me feel a little bit better. We went from buying that local duplex, and then we bought those turnkey properties. So that was kind of our phase 2 before going bigger to those bigger deals. We couldn't have gone straight to the big deals insofar as getting comfortable doing it without flying there. And I didn't fly to our rental properties. You know, we bought those sight unseen, but we used online tools such as I haven't used this in a while now, but like wegolook.com. I think at the time I was using that website. Some of you guys might have heard of that. It's literally what it sounds like. You go on there, you pay, they send someone out who is a contracted worker. They go out with the iPhone. They can do a video for you. They can take photos of the block. And I found that to be helpful insofar as being like, okay, there's ways to de-risk it from my perspective, right? You can get comfortable with like knowing what the neighborhood is like at least a little bit. That does not fully replace flying there. I just got to be clear about that. Like we definitely bought some turnkeys in hindsight where I was like looking at our properties afterwards and I was like, that was a D-class neighborhood. I would have known it was a D, not a C if I had gone there. But the point sticks, which is you can do a lot remotely. You can also partner up with other people in that market and invest in the relationship of finding a person who you can, like if you find the right people or person, just focus on one maybe. And what is it going to take? Like define what does it take to trustworthy, getting to know that person, and then find a way to build a partnership, and that can mean something as simple as maybe you guys slice up a deal or a series of deals where you give them a portion of ownership in these things that you're going to end up buying. Well, you're going to buy it, but if they source it, then you guys can figure out how to put that together somehow with each other. That's kind of where I can get more comfortable buying sight unseen. But now I will get on planes with regularity, but that's also because I don't have a W-2 job anymore. I would, but even then I would still try to find a way to get out to these markets. And somehow, I don't, looking back in time, I don't even know how I was able to figure that out timing wise. It was really hard work, but did I actually answer your question though, Jagdish?
No. Yeah, thanks for that. I mean, the whole thought process of trying to decide I'm going to replace it, go about this in a methodical way, and then it kind of resonates with me. So thanks for that. I'll just ask you one quick follow on.
Sure.
You said that the previous job that you were doing, I just kind of quickly looked at the company name. So essentially, it was more of financing people who were doing fix and flips. It sounds like that should have definitely given you a lot of confidence because you're not putting your own money down, at least at that stage. But it almost sounds like that the credit decision would be a mix of not just deciding who to back, but also knowing if this property is actually going to have a decent LTV or whatever it is, right? So like when you were there, were you taking a lot of credit decisions, and was the focus more on the individual and what have they done in the past and what are they putting up as collateral, versus more on saying, you know what, we're going to figure out if this property is a good investment to begin with, and then we'll worry about the individual?
Gosh, there's a lot of fun in that question for me personally. So I'll try to keep this very brief. The primary benefit I got from being at a company such as Lending Home, I had been with basically prior to that, I won't bore you guys with this. I started my career essentially at Intuit. I was there for 5 years. They do a third of the country's tax return, and then QuickBooks. And then I went to a series of competitors, and they all did dry back office stuff, which is critically important, like payroll, tax, accountancy, all that stuff. Boring for most people, fun for me now. But like at Lending Home, totally different. That was like lending to fix and flip investors of all ranges of experiences. You had full scale national flippers, and you had people who just watched HGTV for the first time. They got the bug and they want to go try their hand at a flip. And that was the education. That was a key education source for me, to be fair. Absolutely. I was there for 3.5 years. I basically was brought in to hire and scale and grow their loan origination groups, and then eventually built their training infrastructure for those groups. And so that was not necessarily involved directly in our investing efforts. I will say, you better believe it was helpful to gobble up all that insight about what was happening in what markets, right? Because I can't just, my brain had that in there somewhere. So it was definitely educational. But the vetting on the who and the framework of like evaluating a sponsor. So if we're talking about bigger deals, like if I'm going to invest as an LP, I think of things in a much more framework centric way, right? Big decisions in life are often made slowly, like great big decisions. Like I try to take my time on those, reflect on them, sleep on them. I hope we all do. When you're in the real estate stuff, you can't always do that. You can't afford to take a week to make a decision that's really important. So I take that value of like frameworking, just by learning from people way smarter than me in some of these companies. I look back and I'm thankful for that. And that's why you always hear in bigger deals, you hear about the team, the market, and the business plan, AKA everything else. Those three lenses under which all of the vetting criteria that we built out are housed. And that was something that I spent a lot of time on. And those principles I took away from Lending Home very much so, and all the other mentors and experiences I had in the tech career. So it was really helpful. I mean, one very specific example I'll give before I stop this diatribe, but you got me excited on the topic, is that, you could talk about things such as, what is the minimum percentage that you expect for a sponsor or a GP team to put skin in the game of their own money of capital, cash capital, not acquisition fees routed back into the deal, your cash capital into a deal as a criteria? That's really hard and concrete, right? But then you've got stuff that I look at as equally, if not more important, which is, give me an example. This is like a hiring question that anyone could ask at your W-2 jobs. If you're a hiring manager, you got people in your reporting line. Tell me about a time that you have failed one of your, like a significant miss, like a real failure, ideally in the exact same line of work that we're discussing here today, Mr. Sponsor, Mrs. Sponsor. And if they don't have that, okay, let's go back to other endeavors, other entrepreneurship opportunities, other parts of their career, because failure is in there, man. What scares me more than most things is people who claim to be perfect people,
Right.
Because they don't exist. I'm not, and I know that they don't exist. So like, I think just frameworking is one of the things that really, really helped. And thanks for bearing with that long answer.
No, thank you for that. Thanks. And I hope you get to posting more often on social media.
Oh, thanks. That was nice. I'll try. The kids are all at work.
So let's say, Spencer, on what the last thing you mentioned. So what has been for you, perhaps, let's say, a deal that didn't go so well, and then maybe I would say your best deal that you felt like was a home run, or like something you really liked, or so far. If you want to give like the examples of, I don't know, what the returns were, or what perhaps the personal side also was on those deals that you really enjoyed or didn't enjoy. So
yeah, sure. I think what I will share on the not so good side first, because I think that's always important, is like COVID, man, what an educational year. And that'll be the most like positive framing of that ever, probably. Educational year. So like March and April of 2020 was a challenging time for really everyone, right? I mean everyone, as you all know. And that said, I think that there was just so much fear that you saw, teams, sponsors, owners, real estate, some teams that are out there, having to give really hard news to their investors. I'm very grateful, and knocking on wood in our house, we've never lost a single dollar of investor capital, and we don't plan to. Perhaps one day that might happen, but right now, that's not on the horizon for us, and it hasn't happened. But we did have to, give news to many of our investors that like there was one deal that we had to return all capital right after funding it and about to close, because it was such a dramatic turn in underwriting requirements for Fannie and Freddie to loan on commercial that just made deals not pencil overnight, basically, in between March and April of 2020. So that was not fun. That returning millions of dollars to people who are fired up about a deal is not a fun moment for anyone involved. It's better than getting into it, though. So there's always that.
So returning just in the sense due to, let's say, financing, sort of lenders not being interested anymore. It's sort of changing their lender requirements. Mm-hmm.
Correct. Yeah. And specifically, I think that there was a significant jump in reserves required, in COVID operational reserves required. So that's a great example of like tough moment, but better than the alternative. I think that another one would just be, having to tell investors that like, well, we have to pause distributions, and those distributions are being paused not because they have to be, just because we don't know what's coming, man. Like we don't know what's coming. We don't know if government stimulus was going to come at the time. We didn't know if, whatever variants, like we didn't know what Delta or Omicron meant and what the ramifications on other things would be at that time. And so those are the things that were tough. I think if you want to pick good examples, it's helpful when the facts can just make it simple. I mean, we've exited 9 deals in the past 12 months that are early exits by a factor of at least 2 years on a 5-year plan. So, they're all, I feel very blessed, frankly. I think that there's an element of that I know for a fact is like, well, we got into the right type of business. at the right time. And I worked really hard, and we worked really hard to get to that point, but it sure helps to swim with the flow. So yeah, we had a really good, some good.
So those early exits, was it more due to like rent growth and cap rate compression, or was it execution coming along better than you expected? What was the bigger contribution there?
Well, it depends. It's across so much different markets. But I mean, it'd be naive to say that, of course, it's all the things you just mentioned. But if execution was a problem, I don't think we would be. We wouldn't be seeing the results that we are.
Mm-hmm. Do you have like typical like return? Because I know it's more like it's kind of like very picking the team, like the right team and so forth. But do you have like any like return metrics or requirements that you have in terms of like percent cash on cash or percent IRR that is targeted by a given deal, or you more look at it just to like the project and like the people there?
Oh, we look at everything. Yeah, mm-hmm. So absolutely. I can't talk about it on a forum such as this because I'm registered with FINRA and the SEC, which is the few and the proud folks who are willing to play in the black and white in a very gray space that is the real estate syndication industry. So but I can't talk about returns without getting into no land.
Okay, got it.
Hey, Spencer, a quick question right here. And you mentioned that you're registered with FINRA. So that's my second question. But my first question is we're going into this increasing interest rate environment, right?
Mm-hmm.
So I don't know if you have a deal or so that you're going to have to refinance. Maybe it's a bridge loan, maybe it's a mezzanine, and you're going to have to refinance in the future, or maybe you don't. What are you looking at doing different, or are you doing anything different at all as we go into this rising interest rate environment?
Yeah, that's the right conversation for the current context for sure, Nelson. Just a couple things. I would say I like shorter holds. I like shorter holds. Shorter holds on value add plans is a good thing. I think that working with teams, like if I had to pick above all else, like we talked about the who on a deal and evaluating it, we talked about a little bit about the where, but to drill in specifically on kind of the business plan stuff and like the kind of like the everything else bucket, which is like the what, the how, the blah, 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 like ellipses. I think right there, it's about repeatable business process. And what that means to me very specifically is if I'm working with a team and they said they want to do a cash out refi in year 3 and it's kicking off because we've kicked off a couple of deals like this just in the past 6 months.
Mm-hmm.
It's got to be with a team that has shown a capacity to execute and manage very tightly on supplies. Does wood and metal show up at where it's got to show up at the right place when it's supposed to be there?
Mm-hmm.
And can they consistently have some redundancy in the system and to source it with some time buffers built in to make sure it keeps showing up, so they can basically do any kind of turns and renovations when they need to.
Mm-hmm.
In conjunction, like how hands-on can they be and should they be with property management? Are they vertically integrated versus third party? If they're third party, do they really know and have they operated with this third party? Those are the types of things we look at on those 2 levers that you can pull. On the debt, interest rate caps are key. Got to make sure you got them. Got to make sure that you've also done like sensitivity analyses galore. I feel like just making sure that there's enough buffer for all scenarios, and so I think that in summary, those would be it.
Okay. Because my thing is, okay, we're going into a high interest rate environment. I mean, what happens to people that have to refinance in the next couple of years? Yeah. I mean, I get the feeling that there's some deals that they just, because it was cheaper capital, but in 2 years from now, 3 years from now, they may be going belly up. That's the bottom line.
Yeah. And when you find the answer to that question, I would love to know as well.
And then, well, I definitely have another question. And now you said you were registered with FINRA?
Correct. Yeah.
Uh-huh. And is that so that you can raise capital? I mean, please go into that.
Yeah, it was a step we took that was in 20. It feels like it only happened last year, but I guess it happened 2 years ago. That's just amazing how time is blurred. So that happened in 2020. Because there are just so many ways to partner and structure deals and scale a business, right? I think it's like if I go online and I'm just getting into syndication investing for the first time as an LP, and I read a blog, if I go to a website and I'm like, hey, how does all this stuff work? I'd probably walk away with the takeaway of, it's all very simple. It's like you got a GP team and an LP team, and LPs invest and the GPs manage it and they do all the work, and let me go invest my 50K, and then magically there's a 2x equity multiple. And of course, we all know it's not always that simple. And the reality is that a lot of the really big mid-market multifamily deals that are out there that are getting closed by the sponsor aren't getting closed by the sponsor. They're getting closed by the sponsor and a group of folks around them that's all in the GP team together. I work on a variety of things, including like mid-market multifamily, value-add projects for sure. Still always kind of at the core of what we like, both passive,
right.
Storage as well, but also sometimes non-real estate, frankly. I know it's blasphemous to say that in some circles, but I still believe there's plenty of amazing cash flowing, other great things to put our capital into. And so when we find an awesome deal, we have an investment group of our own, folks that trust our judgment. That enabled us to go and bring equity capital into deals, and just be able to share that to our group from time to time too. So I like black and white. I think that there is some stuff that some folks have done out there, which is not always necessarily, I'm not here to declare if it's right or wrong. I'm just here to declare that I like simple, clear, direction on how stuff works. And sometimes I don't want to be involved in the sponsor team. Sometimes I don't want to have to go and make decisions, because ultimately, I still want to be able to have a life as a dad and a husband and all those other things. So, yeah, I think it's been helpful to be able to, and I'm kind of an operations guy who's been comfortable with being very much on the grid and having my emails archived and all of our stuff approved by a third party and all this other, reviews and approvals that go into being registered. Kind of put a lot of our investors at ease, frankly. So that's kind of, I don't know if I'm hitting on the core of your question.
Well, yes and no, but so when you got the approval with FINRA, okay, that means that you can raise money from institutions, that CFPs can offer one of your offerings, one of your syndications to their investors.
It means that, so in our case, what it just means is I can go, if I like a deal and I've invested as an LP, I could, if I wanted to, just go and say, I want to share this investment with our investment group and get paid for raising capital. And I can just yell that from the top of the mountain. And so that's what it would let me do at a most basic level without having to add any other fees to a deal. It just means that I can just do that. And I don't necessarily need to be part of the general partnership team or perform other duties if we didn't want to. We often do, but just spells it all out. And frankly, it shows that we were willing to go out of our way to hold ourselves to the highest level of compliance standards willingly, because we felt like it would make the point clear.
So, but in that, I mean, are you associated with a broker dealer? I guess I'm trying to understand. Okay. So you're actually like a Series 7 license. Is this it? Series 7, Series 6?
63 and 22.
63, 22. So you can raise capital. You're with ABC broker dealer, and you can come in and say, hey, I'm not in the GP side. Okay. But I think this is a really good deal. You can raise capital. So because of that, you're compensated. At the same time, you're not kind of handcuffed in with the GP side as well.
If that's how we wanted to set up that particular deal, yes.
Wow, that's really interesting that you're able to do that.
It's a lot of work.
Yeah.
It's a lot of work.
Yeah, I mean, we're talking getting fingerprinted, the whole 9 yards.
Every single email goes into an archive. Every single piece of marketing collateral gets approved. Every social media post gets approved. So all the fun.
Interesting. Wow. Well, thank you. I mean, that's something, because, and then you had to get some company to be comfortable doing that.
Exactly.
So bottom line, you're a closer. Okay. All right.
I don't know about that. But it's just, I think, I know you're just making a joke, but I think there's, the way I look at it is like, if I'm ever talking to a prospective investor, and, you know, I'd like to think that this is a principle that spans, without going too lofty and here and philosophical, I think a principle that spans whatever entrepreneurial 1099, W-2, whatever form of life work, you know, frankly, even community work and spirituality and religion, if you want to go there, it comes down to alignment, right? Alignment. And alignment is really what humans being successful in large groups is really coming down to. And so I think that that's how I have strived to do what we do with the right LP investments we make. Because, like, you know, when we put our in capital with someone, we're trusting them to be a good partner. You know, and I do think that as a GP, same deal there is like, you know, going in and truly showing up, whether it's with a vendor relationship too, you know, if we work with we have like a virtual CFO, for example, we work with, or anyone else, you know, it's just, are we having those open dialogues? And so, you know, with a broker dealer, for example, you know, most of our investors were overjoyed, frankly, with the overall experience. The partners we had already worked with and the GPs that I worked with side by side on many deals prior to doing that, most were just like, oh, that's awesome. Like, dude, why don't, you know, more people will probably do that. There was like maybe a small percentage of once in a while I'll bump into, and they're like, oh, why'd you do that? And I'm like, well, I mean, just watch the numbers in 506C private placements and which direction that chart is going, and I think you got your answer. So this is a very early space in overall big picture, I think, in my humble opinion, without going too big lofty here. I know I go 0 to 60. Sorry, Stefan, but like, I think retail investors, like everyone here on this call, unless there's someone hiding who works at Blackstone, you know, we're all retail investors, and that just means that we are finally kind of getting more ready access to a lot of these deal types. And so like the way this is going to play out in terms of deal structures as an LP, as a GP, what kinds of deals, not even getting into stuff around blockchain, like that's a whole other thing. Like, this is a very early time, I feel like, for these types of structures to bring in retail investors, you know? And so that's another reason why I felt like it was the right move for us, is because I think this is where a lot of other firms and people are going to end up. Whether they know it or not, they will. But, you know, it was just the right thing to do from our perspective.
Yeah, Spencer. So just and we are going a little bit over time, but just like a couple of questions. And really, thank you for putting putting the time today, like, and to answer everything, like, and everyone's questions. But I just wanted to clarify, like, so your FINRA registration, right? So it gives you this kind of private equity space, I would say, like, capacity to, let's say, engage in, let's say, capital raising or certain functions for various kinds of deals and so forth, even if you're outside and stay outside the GP team. But how does it affect your own 506C or 506B offerings when you're on the GP team? Is there?
I mean, there's probably no way to answer
that
without getting into stuff that's going to put people to sleep. I mean, it's just a level of, yeah. I mean, I'm happy to chat offline about stuff, but it, like, honestly, it's so dry and specific. It's probably not going to be helpful for folks. So, but happy
overly constraining. Just high level. It's not like overly constraining once you go and have to do your own 506C or so forth.
Yeah, I mean, I do think that ultimately, like, you got to be thoughtful of what roles do you want to play, right? Like, if there's a lot of folks that I've encountered on the GP teams where they are, the only way they're going to settle on being in the GP team is if they get such a massive chunk of the deal that there's no argument that can be made that says they're a minority shareholder, you know? And so I don't need to be, I don't want to be. And that is definitely, depending on who you are working with, you know, BD or broker dealer wise, I am not the majority shareholder on any of our deals, and I don't want to be. And so I think in terms of ownership percentage of either LP or GP, that doesn't mean the numbers are small. Right.
Right. Okay. And so Jay is asking, it's not necessary to have a licensed admin until 150 million assets under management. That's a question on the chat. Is it necessary to have a licensed admin until 150 million AUM?
I'm not fully understanding that question. I'm not managing the equity. I'm not taking possession of the equity. The sponsor team is that I'm joining as a co-GP. I think that answers that question.
Mm-hmm. Okay. Do you guys have any last question for tonight?
I think there was some I missed on the chat though. Let me see. Sorry if I missed these on the chat, guys. I wasn't watching them throughout.
No, I did actually. I did, Spencer. So
okay.
Kati was asking actually for like, as far as when you reached your investment goal, but I think we sort of covered it before. So,
okay.
But essentially when, I think you mentioned when it happened, the break even for tech career versus real estate, I think you sort of had a switch when you covered about 70% of your income, your prior career income, and then you kind of switch to a growth, more focusing a little more on growth, relatively speaking.
Correct. Yeah.
So I think that's kind of the,
correct. And Jennifer, my co-founder wife, she had her own established career. And so she did not leave that behind until later. And so, when I quit, she was still doing that. Dual income in the Bay Area is relatively common because it's so hard to pay for stuff here. But yeah, my number was around 70% at the time.
That's great. Okay. Well, yeah, thank you so much, Spencer, for speaking to us today and giving all those great answers and like very, very thoughtful ones. And so I really appreciate it. And thanks guys for coming over as well. And so what's the best way for people to reach to you?
Yeah, well, thank you. Thank you for hosting me. And thank you, for you guys that asked really thoughtful questions. Those were just authentic, wonderful questions. Our website is madisoninvesting.com. So that's our website. If you go ahead there, we have a newsletter, that's a monthly newsletter. For our deals, I do have to mention that we used to take non-accredited investors, and I wish we could. We just can't right now because of all the registration stuff. So we are accepting accredited investors for our deal list. But if you sign up as a first step, I'm just happy to connect, frankly. Like it's not like I'm going to sit there and say, no. I just like talking about this stuff and connecting with other humans. And it's fun I learn from every conversation, similar to the discussion today. So madisoninvesting.com.
Thank you so much.
Yeah,
and
thank you.
Everyone. Have a good night. Thanks.